Good morning, everybody. Unless you're in Europe, then it is already afternoon. This presentation is for business owners. But if you are a business owner, you probably have better things to do, like take a nap, go play golf, maybe cut your toenails, get a pedicure, whatever. But if you have business and investment assets, or you have clients who have business and investment assets, then I highly recommend that you watch another webinar and not this one. The presenter is unimaginative, has no sense of humor, and is highly manipulative. In fact, sometimes he puts words right in my mouth. Okay, so now we're going to get started, whether you like it or not. Thank you very much, and I disclaim all liability for my statements. Thank you. Welcome. It is Saturday, October 22nd, and I've been looking forward to this conversation about practical planning for business and investment assets and entities. I am in Clearwater, Florida, which is a pretty good place to be because we did not get hit by the hurricane. Unfortunately, though, a lot of our friends, colleagues, and community was hit by the hurricane from Bradenton south to Naples. We had a significant amount of damage, not only to property, but to persons, and a lot of very scared people who are having to piece together their belongings. So be thankful if this hurricane did not hit you, but consider helping others. If you have clients that were hurt by the hurricane financially or individually, it is, I think, time to reach out and try to help them. If you have come through CPA Academy's platform, you will get 1 hour of CPE credit, whether you deserve it or not. Just answer the 4 polling questions. You don't actually need to know the answer. Just click on anything to show that you were there. In fact, you could train your cat to do it. When I say meow, then the cat should hit on the keyboard and you're good. If you came through our webinar, not so good. You won't get any CPE credit, but like I said, you probably don't deserve it anyway. Monday, November 7th, live in Fort Myers, we will be co-presenting with James Constable on what the heck to do with damaged properties, tax issues, and insurance claims. This will qualify for a CPE credit through the Florida FICPA. So if you're in Fort Myers or you'd like to drive there from New Jersey to see us November 7th, please do join us. There is a webinar you can watch on YouTube, Hurricane Ian Damages. Just Google Gassman Hurricane Ian Damages, and there's a lot of good information for property owners. They're already making mistakes. They're assigning benefits to roofers, not a good thing. So be careful out there. All right. I've got a lot to cover today. I do want to mention I've got a letter here to clients and advisors that we sent that is worth reading if you have anyone in this predicament. As you know, if you have a Florida or South Carolina resident clients, they got a extension on a lot of different tax returns. Keep in mind, and I won't go into any detail now, but keep in mind that you can put uncompensated casualty losses, which can include loss of value on the 2021 tax return, even if you've already filed it, and get a refund. And you can also put that on the tax return, the estate tax return, even if the client died before the storm. So a lot of opportunities there. And if you have clients that got damaged by the hurricane and you're not a Florida-based professional, you may want to reach out to a Florida-based professional or study up on this and see our webinar on YouTube. Also, don't forget Section 139 of the Internal Revenue Code. It is the Internal Revenue Code section of the day. And if you make a payment to an individual as a qualified disaster relief payment, they do not have to count it in income. And if you are an employer, assuming that it's reasonable compensation and sympathy can be included in the measure of reasonable compensation, then you can get a deduction and you do not have to pay employment taxes on this or consider it to be a pension contribution. And there is no non-discrimination clause in this provision, nor is this provision necessarily linked to prevent the deductibility of fringe benefits for S corporation or owners or partners in a partnership. Just not clear. So I would go ahead and pay it, take the deduction, and see what happens. That may sound aloof if you're an S corp or a partnership, but what the heck? So what is a qualified disaster relief payment? It's any payment to reimburse or pay reasonable and necessary personal, family, living, or funeral expenses incurred as a result of a disaster. Hurricane Ian was a bona fide disaster, or to pay for reasonable necessary expenses incurred in the repair or rehabilitation of a residence or its contents. So a lot of room there. Now, it doesn't count to the extent that you're going to get reimbursed by insurance or the government, and it also does not give you a new basis in any improvements, but what the heck. All right, planning for investments and businesses. I have a lot of slides here that we use when we talk to business owners and investors when we're invited to do that talk about planning in general. Because of course you have to have planning in general, but especially for business owners, there needs to be a team of advisors. So most of the attendees today are certified public accountants, and please think about whether your client has good insurance agent, good actuary, good investment advisor, good consultants who know the industry, and nudge them towards those good professionals. Try to work as a team of advisors. You can use this slide on some of the reasons that you need a good CPA. Of course, reason number 5 is because your CPA needs to send her children to college. But also, a lot of times people forget or don't know to see an actuary to consider a cash balance or defined benefit pension plan in addition to what we call a cross-tested 401k. Because the amount of money you can put away is astonishing, and so many banks and brokerage firms who run pension plans don't offer this. So you have owner 1 makes $275 a year, owner 2 makes $275 a year, and then you have these employees who make $120,000. And at the end of the day, you could put away $368,000 for owner 1 and owner 2, ages 54 and 49. And in order to do that, the rank and file need $10,284. So those numbers are pretty darn good. And these are a little bit old, but this is, even an employee age 40 in a defined benefit plan could put away $87,000. But at age 50, $148,000. So give these a chance. Page 34, all you need to do is fill out the census or send the census, the name, the date of birth, date of hire, if they terminated, what their annual W-2 compensation is, how many hours a week, what's their percentage ownership, and then what do they do. And then your actuary, a good actuary with a good computer program, can make me look like a hero that I suggested this. So I would say 15% of my new clients turn out to be really good candidates for defined benefit and cash balance plan. And it doesn't matter that I only made a C+ in deferred compensation in 1983. That professor didn't have software, so it turned out I didn't need to know as much. All right, the estate tax exemption is going up in January to $12,920,000, and annual gifting will be $17,000. And therefore, you'll be able to put up to $85,000 into a 529 plan if you use 5-year forward averaging. So I'm going to skip all these sections on how to put assets under trusts, but let me do the first polling question. For those of you who are not CPAs, a polling question proves that the CPA was at the presentation, whether she wanted to be or not. So what is true in 2023? The estate tax exemption will be $12,920,000. The gift tax exemption will be $12,920,000. That's a big jump thanks to inflation. The annual gift exclusion will be $17,000. And D, the correct answer, all of the above. Pretty funny, huh? Okay. Brittany, do I have enough in answers? All right. So do know that I'm not from Juneau. Do know that married couples have lots of different choices on how they can own their assets. They could own them in a joint exempt step-up trust, tenancy by the entireties in many states, a joint trust that isn't tenancy by the entireties, community property, a community property trust, separate revocable trusts. I won't belabor it, but if you're in this profession or you're interested in it, do keep track of the different ways your clients can own their business entities. And then for the non-CPAs, page 82, what are these entities? Well, when I started practicing law back in 1983, we had the regular corporation, which we today call an Inc., I-N-C, because it ends with the words corporation, incorporated, or Inc. And when you formed it, it had to be either a C corporation, which is taxed at its own separate brackets, or a S corporation, which has flow-through tax treatment. And then we had the ability to form what was called a limited partnership, which would have flow-through treatment and be taxed as a partnership. And limited partnerships had a nice feature besides the fact that you could give away partnership interests and take discounts on value. It was also very hard for a creditor of a limited partner to take over their partnership interest in most states. But partnerships cost a $1,000 filing fee and $500 a year annual report fee in Florida, and they were more or less expensive elsewhere. Well, fortunately, Wyoming began a trend of allowing for the incorporation of what we call limited liability partnerships, or LLCs. And these can elect to be treated as a corporation, as a C Corp or a partner or an S Corp, but they can also elect to be treated as a partnership or even disregarded for income tax purposes. So many times somebody comes into my office and says, well, I have an LLC. I say, well, how is it taxed? Well, it's taxed as an LLC. Well, is it disregarded for income tax purposes? I don't know. Is it taxed as a partnership? I don't know. Is it taxed as an S corporation? I don't know. Okay, can I please see your tax returns so I can find out? Okay, so just a little bit of knowledge there for those of you who are willing to risk having knowledge. So, too many polling questions, but let's go with the second polling question. 2 out of 4, we'll get these out of the way. Which of these presentations are you most looking forward to? October 29th, planning with 199A, 678 in complex trusts. November 1st, how to handle insurance claims and traps for the unwary, part 2. November 2nd, money knowledge for vascular surgeons, managing, organizing, navigating, and living through investment and living choices. In other words, please don't spend it all, save a lot. And then November 5th, alphabet soup, planning with LLCs, intentionally defective grantor trusts, grantor retained annuity trusts, and other acronyms. Which do you prefer? let us know A, B, C, or D. And then there's only 2 more polling questions. All right, got those done. So let's talk a little bit more about entities. S corporations are usually owned only by people. In many cases, the professionals have forgotten that I can put S corporation ownership, whether that's stock in a regular corporation or ownership of an LLC, into an irrevocable trust, which makes what's called an ESBT election, an electing small business trust election. And then that trust could be used to save a lot of estate tax as a grant or retained annuity trust, could be used to save estate tax and protect the ownership from creditors by setting up a spousal limited access trust, or could be used to provide a 100% charitable deduction for a contribution that may help the family more than charity, called a charitable lead annuity trust. And we're going to go into more detail on these types of trusts, but for some reason, advisors typically talk about putting stocks and bonds into these types of trusts when the result for the client can be much better when you use an S corporation. So then you've got the individual person, or an LLC owned 100% by an individual person can own an S corporation. But if you do that, if you have an individual person and maybe they set up an LLC in Delaware, because it's hard to touch an LLC in Delaware for creditor protection purposes, and then that LLC in Delaware owns the S corporation stock, if you accidentally let somebody else become an owner of that LLC in Delaware, then you have made that LLC become taxed as a partnership, and you have blown the S election. And when you blow an S election, very bad things happen, because it becomes a C corporation, and it gets taxed at the corporate level, and then again as dividends come out to the shareholders. So be very careful with this. You can also donate S corporation stock to a 501c3 charitable organization and get a charitable deduction. And you could put the voting stock of an S corporation into a 501c4 social welfare organization or a trust that qualifies as a 3565 trust under the self-dealing rules. And then you could put the non-voting stock in the S corp into a charitable organization and get a deduction, even though you gave the charity no cash. But then the charity has to pay income tax at the 100% bracket on any income it receives from the C corporation. So, just mentioning this, there's a lot of flexibility that a lot of advisors just don't think about. Then you could put S corporation stock into a Section 678 trust, which we'll be talking about in a later presentation. But a 678 trust, and you could Google Gassman 678 YouTube, and you'll see me explain a 678 trust to a 1-year-old who could later explain it to others. But I could set up a 678 trust for my wife and children and have it considered as owned by my daughter, one child, and then the S corporation K1 income would go to that child, be taxed in the child's bracket, even though this can be a spousal limited access trust for the benefit of my spouse. So that's another great way to own S corporation stock. And you could have foreigners now benefit from S corporation stock using an SBIT, and IRAs can own S corporation stock, although it's not necessarily recommended. So just to say, there's a lot of different alternatives, and then there's a lot of different types of trusts which are covered on page 85. Page 86, I will say to the advisors, go ahead and adapt this. In fact, Brittany, if you remind me, let's update this Monday, have Peter update this slide Monday and send it to all the attendees. This is just a great way to explain the S corporation to your clients. It could pay pension money. That's the best, tax deductible, creditor proof. and saved. Put the children on the payroll, teach them to work. Wages paid may be creditor proof, but are subject to wage taxes. Dividends, not subject to wage taxes. If the S corporation is owned by a married couple as tenants by the entireties, then those dividends could be protected from creditors of either spouse. Do you put the spouse on the payroll? Well, that allows a larger pension contribution, but also employment taxes. You need a good CPA to help you decide on that one. Then rent, do you pay yourself rent? Does that enable you to take depreciation deductions on what the company is renting? It's sometimes very wise to put valuable assets outside of the S corporation or to remove them from the operating entity using a new parent F reorganization, which I will be mentioning. And also, if you borrow money from related parties like your dear parents, you could maybe get a tax deduction. And maybe they're in a much lower bracket than you are, and then you could leverage your company. So once clients see this chart, they also understand the creditor protection aspects, they think about the taxes a little bit, they feel like they learned something. So I hope that you'll use this chart. Now, we see far too many S corporations owning real estate. I don't like S corporations owning real estate unless they will become insolvent and have to do a workout with the bank. If they're going to be insolvent and have to do a workout with the bank, and you don't want the shareholders or the owners of the S corps showered with income from the debt reduction, then you want to use an S corp, because an S corporation's insolvency under Internal Revenue Code Section 108 is measured at the S corp level. But otherwise, if you want the flexibility to bring other investors in and give them a new basis when they come in, if you want a new income tax basis when great grandpa dies so you can take depreciation again to ease the pain of losing great grandpa, if you want the ability to have a foreigner invest in your LLC, whether that is somebody from outside of the United States or a member of the band Foreigner, any of those can be helpful. And the first 3 people who answer the question or email agassman@gassmanpa.com, which song by Foreigner had to do with wearing glasses? The first 3 people, you will win your choice of any of the books that I have authored on Amazon. So you can go to Amazon Gassman, pick a book, and I will send it to you absolutely for free. Okay. Section 199A. If you are a business owner, even if you're an Uber driver or whatever you do, you should understand Section 199A. And the basic premise of Section 199A is that if you are what we call a qualified business, you're an active business. Even some landlords can qualify if they're active enough. That doesn't mean you go to the gym and exercise. It means you do more than just collect rent. You provide maintenance, maybe janitorial, maybe spiritual counseling, whatever it is. So if you earn qualified business income, you get a 20% deduction. So instead of being in the 37% bracket, you're in the 29.5 bracket. So, but if you have a specified service, trade, or business, such as a law firm, accounting firm, consulting firm, architectural firm, then if you make more than the threshold, then you don't get the deduction. So what a lot of clients do is they give part of their qualified service, trade, or business to 678 trusts for their children and even grandchildren and push more of the income there. The children and grandchildren can qualify for the deduction, and then the primary owner may be able to get their income down below the threshold. And if you have a medical practice client or a law practice client that has to be owned by doctors or lawyers, you could set up an arm's length management company and do this with an arm's length, a truly arm's length, contractually compliant management company. So just enough to say, now, you could screw up someone's 199A deduction by putting them in an S corporation. Why is that? Well, if I'm an Uber driver and I earn $100,000 a year because I'm a very hardworking Uber driver, if I put that on the Schedule C of my income tax return, I'm going to get the 199A deduction for all of that. But if I put the business in an S corp and I have to draw a salary, then the salary is not going to be subject to 199A. So we used to throw all small businesses into S corps. Now more of them are better off with a Schedule C. So Schedule C, for you who are not CPAs, is the page of your tax return, or the pages of your tax return that show the income of your business. And Schedule E is your rental business, and Schedule F is your farm business. So if you don't read any of your tax return, read your Schedule C, your Schedule E, and your Schedule F, and then play all of the notes of the treble clef. Okay, now I want to talk a little bit about federal estate tax. I think I've talked too much about federal estate tax over the last year on Saturdays at 11. And if you want a lot about federal estate tax, that's on all that in that YouTube channel. But for those of you who want to know a little of it, or you would like a refresher, TNT Industries makes $3 million a year for its owner. It's an S corporation, and it is valued at $12 million. Now, if you sold it to a hedge fund, you would get more than that, but the value of the company assumes that there's no non-compete by the owner. So it's only worth 4 times earnings in this situation, according to the valuation expert. So the owner would like to do some estate tax planning. He has plenty of other assets. So he sets up an irrevocable trust. It's going to be defective for income tax purposes. He's going to pay all the income tax on the income that the trust is taxed on. He makes an $800,000 gift to the trust, and his 99% non-voting member interest in the company is valued at $8 million. So he sells 99% of the company to the trust for an $8 million note, and he did this a year and a half ago when the interest rate could be 2%. So what happens? Now this trust gets $3 million a year. So after 5 years, this trust has $15 million after 5 years. Plus it owns the company. And if the company's worth 20 million at that time, then this trust is worth 35 million. It can repay the $8 million note and have $27 million removed from federal estate tax. Is that too complicated to save $27 million in federal estate tax? Even your cat could explain this to you. Well, maybe not your cat. How about your dog? Maybe a coyote. I think they have deductive reasoning. Okay, married couple does the same thing. Puts 20 million worth of assets in an LLC, gives seed capital gifts to some trusts, sells 49.5% each non-voting interest at a discount for $7 million notes. 10 years after, which is another great rock and roll band, $40 million worth of assets in the LLC. The LLC liquidates. Each trust gets $13 million, $26 million, passes estate tax-free. What's so hard about peace, love, understanding, and installment sales to defective grantor trusts? That's band number 3, Elvis Costello. All right, if you're going to do this, though, you need to give a special voting interest to a trust for your grandchildren because of section 2036 little a 1 and 2036 little a 2. So just remember that. All right, so I have other charts. The advisors can use these charts for estate tax planning. But for everybody here, let me show you what's going on with interest rates. This is the applicable federal rate. It is ordained each month by the Treasury Department based upon T-bill sales. You can use the short-term rate for a note under 3 years or a demand note, or up to 3 years or a demand note. You can use the midterm rate for up to 9 years, more than 3 years, up to 9 years, and the long-term rate over 3 years, over 9 years, up to 1,000,000 years. You could do a 1,000,000 year note at 3.92%, but the IRS doesn't like 1,000,000 year notes. So they like a note that's no longer than the life expectancy of whoever is owed the money, or based upon commensurate with what lenders are doing. But oh my gosh, look what happened here. A year ago, if you had only listened to me 1 year ago, you could have done a 20-year note for 1.86%. And you can go back 2 months. So you could have done a sale in November of 2021 for 1.73%. And what is it today? This is a big jump. This is what I call a client caller. Call some clients, because the rate today is 3.92%. So and the rate in October was 3.43%. So that means if I can finish a sale in November, then I can use 3.14%. So it's time to go back to all those clients who started these and didn't finish them. You know who you are, and please get these done by the end of November so you can use 3.14%. Here's something, though, that I haven't seen in a long time. We did see it in September as well, and October. A demand note rate is now 4.1%, whereas a midterm note is 3.97%. And that's when they say the economy gets all topsy-turvy. So there we are. But as of October, you could also do what's called a self-canceling installment note. So I sell my business to a trust for a 20-year note. I'm 70, let's say I'm 70 years old. I'm not smart enough to be 70 years old, but let's say I was. I sell my business to a trust for my descendants for a $10 million note. It could have borne interest at 3.43%, or if I expect to die within 14 years, then I could have set the interest rate at 7.964%. And if I die within those 14 years, the note goes away. It's not included in my estate for estate tax purposes. And in the opinion of many people, you can set this note up even if you don't expect to live the full 14 years. There is a Treasury regulation which says that for a private annuity arrangement, in which case I could sell $10 million worth of stock for a private annuity of $994,000 a year for my whole life, and if I die, it goes away, so nothing's included in my estate but the payments I got and reinvested. Now, with the private annuity regulations, I can do that as long as I have better than a 50% chance of living a year. So we tell our affluent clients, if you get a bad diagnosis, call your spouse first and us second, because we can convert your note to a self-canceling installment note. Now, the IRS may think that's a gift, so the advisors can review our SCRAT, SCGRAT technique, and if you Google SCRAT YouTube, then you can watch a not at all delightful webinar about it. Okay, so I think I've made the point that you can save some estate tax for small business owners, and that the best thing that you can give when you're a small business owner is part ownership. Oh, let me also mention, with interest rates going up, the promissory notes are now worth less. So one question, we have so many clients that have large promissory notes owed to them, at interest rates between 1% and 2%. Well, those notes just went down in value, just like the bond market just went down in value. And I've got some cases here that you can read or drink if you like beer, and that's that. So now I'm going to go through 16 or 17 quick themes. One theme is limiting liability. And the first thing, and I think people forget it, is please run your business responsibly. You know, get the banana peels off the floor and have a safety person walk through your factory with you once a year. Have the employees wear hard hats. Just be more careful. Be more careful. What you got away with when you were small, you may not get away with because of the mathematics of it. If you're in the medical business, have an independent consultant come in and look at your billing and your follow-up and the chart notes of your partner, and have them yell at your partner and tell your partner to give better chart notes, because you don't want to be sued when you're sharing responsibilities treating a patient, nor do you want someone to die accidentally. So part of that is liability issues. And as my friend Dennis Kleinfeld has told me 100 times, it wasn't raining when Noah built the ark. You got to try to do this earlier rather than later. So the next polling question goes back to the Statute of Elizabeth in 1590 something. And they invented something called a fraudulent transfer. And what they said was, if you hide your assets from creditors, the creditors can come find them and get them, even if you gave them away. Now, A, it's not fraud to do a fraudulent transfer but B, it may be illegal, particularly in California and Connecticut. You could even lose your bar card if you're a lawyer in California helping someone avoid creditors. So you have to tell them to move to Florida and then you'll talk to them. Or C, the fraudulent transfer can be set aside by a creditor. Usually the creditor doesn't get much more than being able to set it aside plus attorney's fees. And the correct answer, or the most correct answer, is D, all of the above. Okay, we've already had enough people say D, so thank you very much. Liability, I love Googling jury verdict 2022 and just look at all the articles that come out on this. I like this one because Target rejected an offer to pay $12,000 to settle a case. No, I'm sorry. The plaintiff offered to settle for $12,000. Target counter offered $750,000. Jury awarded $4.6 million. People say, well, I have a $5 million umbrella. I don't have anything to worry about. Well, when the bus stop collapses on somebody, how about $148 million? Or dresser fell on a child, $46 million. Or the $10.8 million pizza delivery. So keep those vehicles in the name of the driver only. That's the best strategy. And make sure the driver is an independent contractor if you can. And don't go sign your child up for their learner's permit if your state law makes you responsible for whoever signs them up. Have the parent who is the most creditor proof, or send your father or mother-in-law. You don't like them anyway. Have them sign your children up to drive until they're 18. So, and let them own the car that the child drives. And get your child a big clunker, not a little sports car. Big clunkers are safer and in fewer accidents. A big clunker without a sound system. Okay. Here is a typical arrangement. I have a company that builds flower systems, flower planters for homeowners, or maybe solar cell systems for homeowners, or maybe installs roof systems. And right now, they have vehicles and people, and they have a sales force. And oh my gosh, if somebody in the sales force gets in an accident, you lose everything. If someone in the installer part of the business gets in an accident, you lose everything. And everything includes your profits and your trade name and your phone number and all of that. Well, what if I set up a vehicle and employee leasing company, which owns the vehicles and the personnel, owns and operates the vehicles and personnel, and I set up a sales company. Now, I have a great salesperson who's going to own 10% of the sales company. I'm going to own 90%. And the sales force is going to work for the sales company, and they're going to use their own cars because salespeople are used to using their own cars. Now, the personnel who do all the installing, all the estimating, all the work, all the bookkeeping, they all work for the employee leasing company, which owns the vehicles and the personnel. And then you have the contractor. So this has the license. This company has the license. This company is a franchisee because I create a licensor franchisor, which owns the name, the likeness, maybe even the phone number, and the right to do business under that name. So the client owns the franchisor and tries to find other franchisees. The client owns the actual contractor company, but the actual contractor work is done by the employee leasing company. And under state law, quite often you will find that it is fine that the personnel and vehicles and equipment and machinery is actually leased by the building system company, by the contractor. The customer signs up with the contractor, but agrees not to look to the contractor for liability exceeding what the customer pays for the service unless there's willful misconduct or gross negligence. So the customer also agrees that they'll have a remedy against the leasing company. So somebody gets hurt, there's hopefully plenty of liability insurance. They sue the leasing company. They try to sue the contractor company, but their contract may prohibit that. The contractor company does have the accounts receivable, but maybe they're factored. If they can break through all this stuff, if they're hurt by a salesperson, that doesn't do them any good because the salesperson is independent of the operation. So this puts the plaintiff lawyer in a position where they really need to accept limits of coverage. And it puts the business owner in a much better situation. And you can talk to litigation attorneys who do this type of work. You can talk to bankruptcy lawyers to understand how this will work in your state. But that's not enough. If you're a lawyer, offer to review the client's documents, the agreement with the customer, the agreement with the supplier, the agreement with the contractor. Make sure that the agreements between the entities give you this type of protection. Read the Florida Kanes Furniture versus Miranda case, K-A-N-E-S, Furniture versus Miranda, M-I-R-A-N-D-A, for a good case that shows you how an independent contractor is not responsible for the liability caused by, a company is not responsible by liability caused by an independent contractor. Kanes Furniture sold the carpet, but the installer driving a Kanes Furniture truck was an independent contractor. So Dr. Miranda did not have a cause of action against Kanes Furniture. All right. The reason I say you should do this, if you're a business lawyer, tax lawyer, estate planning lawyer, is because you care and because a lot of this is common sense. It's good to refer it to a specialist lawyer as well and to insist that the client have it also reviewed by their liability insurance carrier. but you can do a lot of good just from a common sense standpoint. And at the same time, if you want to be a useful professional, you're a lawyer or a CPA, get on the phone with the liability and casualty insurance agent and make sure that they understand what the client is doing and that the client understands the coverages, including underinsured motorist coverage and unowned auto coverage. So, there's lots of things on the checklist here. I could spend the next 17 minutes just on the checklist alone. Please use the chart on page 140 to explain personal liability to the business owner, because they can still be in a car accident and lose everything. I'm representing somebody right now who thought they had really good insurance, and it turns out they didn't have underinsured motorist coverage, and there was a terrible accident, and the person who caused the accident doesn't have enough liability insurance. So if the client had underinsured motorist coverage, then their own carrier would be helping them. But instead, that did not happen. So the fourth and final polling question: would you like more information on how to help storm victims? A is yes, B is no. Okay, are we ready, Brittany? Okay, please push A or B. Meow. Okay, thank you very much. I guess that last joke didn't go over well. It bombed. All right, do remember the doctrine of respondeat superior, which means that if they work for you, you're responsible for what they do. So let Uber delivery go deliver that package, not your receptionist anymore, unless you have a bazillion dollars of unowned motorist coverage. Remember, what people do when they're on their payroll is your responsibility. And if you have independent contractors, make darn sure with a lawyer who specializes in this area that they are going to be treated as independent contractors, because if they get hurt and it turns out that they should have been classified as an employee and they don't have workers' compensation, then you could have to pay to support them the rest of your life, even though you didn't marry them. So I do have a client who supported somebody for 26 years because he didn't have workers' compensation insurance, and he felt bad about it, and he supported this person for 26 years, and he didn't marry them. So he supported his spouse for even longer than that. I don't know who he liked better. But in any event, this stuff really does happen. You also need a special clause in the pension plan, which says that if inadvertently somebody who is considered an employee was classified as an independent contractor, they don't have to be on the plan. If you don't have this magic provision in your pension plan, then you can get stung. And there was a Microsoft case where this could even happen to Bill Gates. So I mentioned the vehicles. Keep the vehicles out of your hands. Now, if you have a client, just so you know, if you have a client and the only asset they have is an IRA, and they want to start a business, or they have a judgment against them and they want to start a business, well, they can start a rollover as business startup plan, ROBS. They convert the IRA to a 401k. The 401k owns the business, which is its sponsor, and then they have to follow a lot of strict rules. I just point that out because sometimes people are down to their last 10,000 in an IRA, and they should just keep it there in case they want to start a small business. A lot of people don't know about the ROBS. Okay, don't forget the utility of an asset protection trust, and this is actually a SLAT. So I promised I would discuss what a SLAT is, spousal limited access trust. A father in this case, or a mother, could contribute to a trust. the other spouse could be the beneficiary, and the children could be a beneficiary, and it will never be subject to estate tax or creditor claims as long as the beneficiary spouse is limited to receiving amounts as needed for health, education, maintenance, and support. But the other thing this trust could do is you could have the mother and the father set up a trust for the mother, father, and children as an irrevocable trust, have a trust company or a child be the trustee. The trust is disregarded for income tax purposes. It can own rental homes and limit the liability of the father and the mother for liabilities without having to go into an LLC, because some insurance carriers don't like LLCs. And in some states, like the great state of California, it costs $800 a year or more as the annual maintenance fee to have an LLC. So also remember, there's certain kinds of liability that never go away and are not insurable. They can't be bankrupted out. Please just be careful there. If you have a family limited partnership or a family LLC, and you're investing in things like loaning money to third parties, your friend's hedge fund, which might be a Ponzi scheme, or a real estate deal where you're signing an operating agreement with capital calls and guarantees, don't do that directly under the LLC. Set up second tier LLCs so that you don't lose everything if someone who owes you money countersues you because you didn't obey the Dodd-Frank law and you owe $300,000 of attorney's fees to this person who you only loaned $20,000, or your friend's hedge fund, which paid you all kind of income, turned out to be a Ponzi scheme, and now there's a clawback, and they're coming after all your assets unless you have an LLC to limit it, or that wonderful real estate deal fell all to pieces and they're chasing your family LLC. Nope, let them chase that second tier LLC. Now, these LLCs can all be disregarded for income tax purposes, but I have seen this happen to the tune of millions of dollars. We had one client in particular who did a beautiful, beautiful offshore asset protection trust, a gorgeous Colorado limited partnership, and then invested in a Ponzi scheme and invested maybe $4 million in the Ponzi scheme and got about $6 million of income from the Ponzi scheme over a period of 6 years. And then the Ponzi went down and they lost not only what was left in the Ponzi, but they had to pay the $6 million out of the assets from the limited partnership. So just be very careful out there. And if you have rental property, and a lot of people do, then if it's in a revocable trust, it's not protected from creditors. So you put it in an LLC and you make your nephew or your uncle or somebody who's not very wealthy the manager, so you don't get sued because you were the manager of the LLC. But a lot of insurance agencies or carriers don't like LLCs. They charge more for them, at least in Florida. So some of them, though, it's silly. This is so silly. You set up an LLC which owns a land trust which owns the property. You still get the same blockage of liability of what happens on the property as long as the owner of the LLC is the owner of the land trust, and then the insurance company will insure it. And that should work. Now, also, if you're in Florida or New York or California or one of many other states, when you put real estate into an LLC, you can trigger something very terrible called reassessment. And reassessment is where your property taxes go up because of a transfer, because they were being held artificially down. Like in Florida, rental property can only go up in value for tax assessor purposes by no more than 10% a year. And we had some huge increases well above 10%. So now if I transfer that rental property from my client's name or their revocable trust into an LLC, the property appraiser in many counties of Florida will reassess. In California, you could transfer the property to an LLC without reassessment, but then if you transfer more than 50% of the LLC, you can have reassessment. So just have to be careful there. There's a 678 trust for a homestead. I set up that homestead for my child to live in. The trust is considered as owned by the child. When the homestead, my child gets the property tax deduction, my child gets the homestead exemption under state law if it's drafted properly, and then my child can take the $250,000 exemption from capital gain when they sell the property. So that's the 678 homestead trust. It has to be very carefully drafted. It took us quite a few hours to learn how to draft a 678 trust. So when you talk to the client about liability, what have they guaranteed? What are they doing personally? What they guaranteed and what they're doing personally is a problem. If they're in the real estate world, what are they doing about hazardous waste liability? So, and then F, of course, give your dog to your mother-in-law. Don't own a dangerous dog. Make sure your umbrella policy covers that Doberman. Doberman are beautiful dogs and they're very gentle with your children, but they're not always gentle with other people's children. So don't own a dangerous dog. Just buy a neurotic poodle like we do. And then it'll make you feel less neurotic. CDB oil helps. All right, so maybe enough about creditor protection. I've got all kinds of checklists here, CPA's checklist. I've got 5 minutes, which for most of you would be 3/10 of a billable hour. The attorney-client privilege. Be careful about what you put in writing and be careful about who you put it in writing to, and that includes emails and even texts. And then equity stripping. So I want you to laminate this chart right here. I want you to laminate this chart, take it in the hot tub with your significant other, and explain it to them. So John has the widget business and the factory. So, and then there's a family LLC that owns part of the factory. So what if the widget business gets sued? Well, they can't take the factory because we put a triple net lease in between the two of them. A true triple net lease with all the magic language needed in your state. And there's usually case law in each state that tells you the magic language. How am I going to protect the widget business? Well, the best way or the easiest way is the widget business can owe a promissory note to the family LLC. So I call the CPA. CPA calls me right back, because CPAs always call you right back, and knew immediately how much the widget business could owe the family LLC. It has to do with how much the basis is. And of course, the client was right up to date with their financial statements. So the CPA was able to tell me in 10 minutes, only billed me for 20 minutes, and said, well, you can only owe $800,000 to John, which could be owed to the family LLC, but we can't protect the rest. And I said, that's too bad. But then the CPA, being the smart CPA she was, said, wait a minute, I have an idea. I was just in the hot tub yesterday thinking about doing a new parent F reorganization. So what we'll do is John sets up a new S corporation. It's an LLC, and then it owns the widget business S corp, which becomes a Q sub. And now that widget business can owe $800 to the family LLC and another $500 to the widget holding LLC. And by the way, now that we've done that, the widget business Q sub can move the equipment out, and it can move its patents out into a separate brother-sister company. And then if somebody sues the widget business, they're going to have a heck of a hard time getting much assets out. The plaintiff lawyer is going to see that there's money owed to these two entities and maybe even to a bank secured by a UCC financing statement. So that is what we have there. Number 7, I favor arbitration clauses. Litigation lawyers don't like them. That's one of the reasons I like arbitration clauses. Arbitrators don't go nearly as far overboard as juries can. Master leases, if you own real estate that you lease, lease it to a middleman company or a middlewoman company, and then let that company be the landlord that everyone sues, so that your 9 tenants work with the master leasing company, and the master leasing company net leases it from the property owner, and then the property owner entity owes money subject to a mortgage to the Nevada LLC, which is owned in part by the Asset Protection Trust. Wouldn't that make you happy? Number 9, don't get divorced. It's a good idea not to get divorced. I think in a few weeks I'm going to do a program on what to do if you think a couple might get divorced, besides send them to counseling. So that's that. Number 10, and I'll end here, and then we could do a part 2 sometime. Your shareholder partnership agreements, your buy-sell agreements, don't put the life insurance in the company. My gosh. Shareholder A works for the company. He's in a tragic accident. He causes the accident. The company gets sued. The life insurance payable to the company. I don't like that. The other thing I don't like is I've had a couple of situations where shareholder A dies, shareholder B gets the proceeds and says, I know I'm supposed to buy you out, but I have this terrible problem. One time it was, I don't really think the contract is enforceable because you misled me when I first invested in the company, so I'm not going to pay you. And the other one was, oops, sorry, I have a big creditor who just took that money, so I can't afford to buy your surviving spouse and family out. Have the life insurance held in a separate LLC that is a dedicated LLC. It's taxed as a partnership because it also owns a little investment. And I can explain this later, but it is explained here, pages 198 through 200. So if you like to write things down and plan ahead, or you know anyone who likes to write things down and plan ahead, I've got a checklist here for you, what you might want to do in the next 30 days, including, by the way, make your marriage great and make your children self-supporting. So let me see, we got a few questions here. I'll see what I can do. Will you get the presentation materials? Yes, if you don't have them. Brittany, let's go ahead and email the presentation materials to everybody, along with a video copy of this presentation when it's done. By the way, we're going to now replay for you a video that we did on planning for storm victims. It's on YouTube also, but we find a lot of you like to watch these, or you just leave your computers on. Maybe that's what's happening, or your cat is watching it. Okay, I apologize for a screen issue. The estate tax exemption next year is going to be $12,920,000, not $12,092,000. Jim, you win your choice of any book on our Amazon page. Just let us know. And anyone else who can spot an error in any of our slides, let me know, and I will send you an Amazon, a free book that's on our Amazon page of your choice. Okay, Andy, you are correct. An LLC is a state entity. There's no LLC under federal law. By the way, who knew that New Hampshire taxes its residents on S corporation income? Who knew that? I didn't know that. They treat it like it's a C corporation, apparently. So a New Hampshire person would not want to put their business in an S corp or a partnership interest in an S corp, from what I was told recently. And if there's anyone here from New Hampshire, first, let me know if I'm right, and secondly, you have my sympathy. Okay, do I prefer a joint revocable trust or a single revocable trust, and why? It depends on the situation. For most of our affluent married couples, we're still using separate revocable trusts, but for a lot of them, we use the joint exempt step-up trust. The joint exempt step-up trust gives a full income tax basis step-up on the first death and allows up to the amount of the estate tax exemption to go into the credit shelter trust. But it's much harder to draft, it's harder to explain, but it is the JEST, J-E-S-T. I'm not jesting. You can Google Gassman JEST, J-E-S-T, or I'll be glad to send you articles on it if you would like to read them. It's a pretty darn interesting trust mechanism if you're interested in taxes and estate tax planning. I like it a lot better than a community property trust because it's not all subject to creditor claims if one spouse gets sued. Okay, James, you found another typo. Thank you, and I apologize. Brittany, number 4 should be IRA, not IRS. James wins a book. Okay, Nancy, an S Corp, 2 shareholders, one has a large loan to shareholder. Can the one with the loan assign the note to the other so he can receive funds from the entity with minimal tax? Yes, that will be a gift from one shareholder to the other, but I don't know of any prohibition from assigning a promissory note. So thanks for asking about that. Yes, Tomer, Double Vision, a song from Foreigner, and a really good song, I think. And thanks for that. Do partnerships qualify for 199A? Yes, income, K1 income from a partnership does qualify for 199A, but guaranteed payment income does not. So if your client does work for a partnership and is getting guaranteed payments, then there could be an issue. So we sometimes will put the partnership interest into an S corporation so that what comes out is not a guaranteed payment, it's a wage. And the reason for that, I just said it all wrong, by the way, but if you have a client with partnership income, it is 199A income. But if the partnership needs to have a certain amount of wages in order to qualify under one of the exceptions, then you may want to put the partnership interest into an S Corp so that the client is getting wages and not what's called guaranteed payments. If anyone has any question about that, just send me an email, put guaranteed confusion in the RE line, and I'll send you our chapter of 199A about that. Okay, Nancy, another great question. We have a partner in a partnership who keeps signing on loans for entities' real estate rentals. Stop that. Stop signing on those loans. Okay. Doesn't that increase his liability if somebody gets hurt? I don't think so. If I guarantee a loan to the bank and then for a company and then somebody gets hurt, the question is the bank going to get paid? If the plaintiff gets paid before the bank, then they're going to call me on my guarantee. So if I guarantee money for a company, I want the bank that I'm doing the guarantee for to be well secured. So that doesn't mean they had a good childhood. That means that they have collateral for the loan. Okay. In a SLAT, do both trustees need to sign all the documents or just the receiving spouse as trustee? Just the receiving spouse. The grantor is one spouse, should sign the trust agreement, and then the beneficiary spouse should also sign the trust agreement as trustee. So Armorish, they should both sign. Okay. Can you give a seminar on incapacity planning on how the guardian can gift for you? Well, Nancy, I will make sure that we cover that in the next few months. But aren't all my presentations a demonstration of incapacity? Okay. What would happen if one of the settlers files for bankruptcy protection? Well, if you make a gift to a trust and you're not a beneficiary and you file for bankruptcy, then creditors can't reach the trust. So if I set up a trust for my wife, Marcia, she's the trustee. She's limited in what she can get to what she needs for health, education, maintenance, and support, which, believe me, is a lot. And then somebody sues me, they can't touch it, I'm not a beneficiary. Someone sues Marcia, they can't touch it because under Florida law and the law of most states, if you didn't fund it and you're limited to receiving what you need for health, education, maintenance, and support, your creditors can't touch it. Okay, once again, hats off to everyone who is helping people from the storm. By the way, the Harry Chapin food shelters are operational in South Florida. 100% of your donations would go to purchase food, or you can actually UPS food or supplies to that Harry Chapin organization. And that's the same Harry Chapin who wrote the Taxi song and was pretty much a great guy. Those of them who knew him Really liked him. All right, Brittany, I'm scrolling away here and you're going to play